Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
This is the ETF Market Insights weekly webinar. Great to have you back with us. I'm Danielle Nezel with BMO ETFs. Thanks so much for joining us. Thanks to our live viewers who are all here today. I see you all logged in. Thanks for coming. And also to our YouTube channel subscribers as well who are watching the replay. It's so great to have you all here today. So today we're not giving advice or any investment recommendations. We are here to provide education, to really just empower investors, to give them the information and the tools they need to stay on top of their investments. And of course, we always like to keep a focus on ETFs as well. So today's discussion, we have never talked about this before, and I think it's a great topic. We're talking about market makers and why they are so integral to the ETF ecosystem and to ETF liquidity. So we have Jimmy Karam joining us today from BMO Capital Markets, and Jimmy is a real live market maker. And at BMO, he's actually on, I believe it's the largest ETF market making desk in Canada. So we are really delighted to have him and his expertise today. And before we get into our conversation, I'd like to show you a tool. So when we talk about market makers and we talk about liquidity, I know a lot of investors out there like to look up liquidity stats, and they like to look up trading volume. So we'd like to direct you to a website, quotemedia.com. They provide really excellent quotes, bid-ask spreads, real-time data, volume. In fact, they have a lot of different metrics to look at if this is something, a route you like to go as an investor. But why I really like Quote Media is because they provide the consolidated quote, and we're going to get into this shortly, but a lot of other providers of information out there don't show you the whole liquidity picture. They only show you the tip of the iceberg. So they tend to show the trading volume on one exchange when in fact there are several different exchanges in Canada. And so Quote Media, they are a great tool to show you the entire picture because they can provide you with the consolidated quote. So our 1-minute ETF update today, let's look at what ETFs trading in Canada look like from a volume perspective. So if you can believe it, the top 20 largest ETFs in Canada actually account for 51% of all Canadian ETF trading volumes. 20 out of, I think there's 1,100 or more tickers now in Canada. So that's a pretty outstanding number to look at. And while a number of mature ETFs have emerged, you know, there's approximately 27 ETFs in Canada with over 2 billion in assets, which still isn't a very large number considering the amount of ETFs out there. There are so many smaller ETFs that are trading below 20,000 shares a day. Now, this doesn't mean that they are much less liquid, and we're going to get into this shortly, but just a kind of an interesting stat to look at or to think about. So when we're thinking about liquidity, well, why is this important? Well, liquidity basically means your ability to get in and out of a trade efficiently and quickly. And this is one of the best benefits of ETFs, because using an ETF, you're able to do this, and not just with one stock or one bond, but with a basket of stocks or bonds very quickly and efficiently. And ETFs also, we're going to get into this later, provide liquidity for less liquid asset classes that trade over the counter like fixed income, preferred shares, and even now we're seeing cryptocurrencies being traded and getting liquidity using ETFs. So I just mentioned this at the top, but I'm going to get into it a little deeper. ETF volume is something that's important to you that you like to look at. And I see a lot of investors questioning ETF trading volume in forums, whether it's on Reddit or in YouTube chats or comment space. The volume data is not always accurate, so you need to be careful when you're looking at it. And here's a great example. So I talked about Quote Media. Another really good site is Stockwatch. They provide consolidated quotes. So I have the quote here for ZAG, BMO's aggregate bond ETF, that I pulled from Stockwatch, and you can see where I've highlighted the top line there. It's giving me a volume number of about 344. Now, that's in thousands. Now, if we look at the Google Finance quote or the Yahoo Finance quote, that number looks a lot smaller. The volume here is 166 or 157. So what they're not capturing is all the trading on all the exchanges. And you can see here Stockwatch actually breaks out the trading on all the different exchanges in Canada. And maybe you'd be surprised to see the TSX there, and then NEO, Alpha, Omega, Pure, Chi-X. There's so many other different places where ETFs can trade. So that is my message for you today. I hope a good takeaway from today's session. Just be aware of volume data and understand that's not the only metric to look at when we're thinking about ETF liquidity. Now, Jimmy, your main job, I would say, is maintaining liquidity for all the various ETFs that are trading in Canada. I think that's a pretty big job. One of the largest benefits of ETFs is that they bring liquidity to hard to trade asset groups. What can you tell us about these benefits and how an ETF might trade versus the underlying holdings?
Hi, Danielle. Well, thank you for having me. Yes, absolutely. You make a very fantastic point about ETF liquidity there. Liquidity is not a function of trading volume. It is definitely, if you wanted to get a better proxy of the ETF liquidity, you have to look at the bid-ask spread and the actual liquidity in the underlying asset that this ETF is gathering. So, for example, the way I like to look at things is, if you look at bookends, so the liquidity of the ETF is, in a worst case scenario, just as good as the liquidity of the underlying asset class. And in certain asset classes, the liquidity of the ETF is actually more superior than the liquidity of the underlying asset class. And that tends to happen in assets such as fixed income, preferred shares, and some of the more OTC asset classes. So we can dig deep into these conversations, and honestly, this is something I'm very passionate about, so I can talk for about 20 minutes or more about these subjects, and I'll probably bore you to death with this information, but you make a very fantastic point. The liquidity of the ETF is just as good as the liquidity of the underlying asset. Now, the question becomes, what is the liquidity of the underlying asset? So this is where you have to dig deeper into what are you trading exactly. If you look at equities, an ETF is just a basket of stocks. So the ETF is just as liquid as the underlying stocks you're trading. So for example, if you're trading an S&P 500 ETF, there's almost no difference to the liquidity. It's an accumulation of the liquidity of the underlying stocks. To give you an example, we recently traded a $1.4 billion switch out of the S&P ETF into an ESG ETF with almost zero market impact. That's sort of the extent of the liquidity that you get in these ETFs. Now, if you look at assets such as fixed income, as I said, the liquidity is just as good as, in a worst case scenario, is just as good as the liquidity of the underlying bonds. But the beauty of the ETF is that it adds more layers of liquidity. So if you look at what is the liquidity of a fixed income ETF? It is the liquidity of the bonds plus liquidity coming from net new market participants, i.e. people that do not have access to the bond market, plus the liquidity of what we call the creation redemption mechanism that is inherent in ETFs. So all that pretty much adds up to making the ETF more superior liquidity-wise than the actual underlying assets.
That's great. Thanks so much, Jimmy. And what we're really showing you here on the screen, we pulled a quote for the BMO Laddered Preferred Share ETF, ZPR, Zipper, as we call it. And you can see there the bid offer spread is about a penny wide, so 11.51 versus 11.52. So that's very, very tight. If you were to look at the spreads of the underlying preferred shares, they are trading at around 8 cents wide. So again, that harder to access asset class in preferred shares has actually greater liquidity when you get it through an ETF. This is one of the amazing, beautiful things about ETFs that we love teaching people about. So Jimmy, you kind of mentioned a little bit about the 3 layers of liquidity in the earlier slide, but let's dive a little deeper into this. So a lot of investors are very familiar with the first layer, this natural layer of liquidity just between the buyer and the seller, because this is how stocks operate. But unlike stocks, ETFs have a couple other layers of liquidity. What can you tell us about those?
Yes, so yeah, exactly. Very good question. And before I dig into that, I just want to use your ZPR example to show something there. So not just are you actually getting a full replication of the exposure that you're looking at, if you take preferred shares as an example of ETF liquidity, when you're buying ZPR, you're getting a one-to-one exposure to the preferred shares index versus if you try and go and buy every single underlying preferred share separately, most likely there are some shares you will never be able to find, which means your exposure is not one-to-one versus what you're actually trying to achieve. And on top of that, your cost of replicating that is going to be much, much bigger. So you're actually getting way better execution using ZPR versus actually trading the underlying prefs. Now, talking about those extra layers of liquidity, this is exactly how we're able to achieve that by adding those extra layers of liquidity. So if you look at, what am I doing as a market maker? So either I'm bringing together a buyer and a seller that perfectly offset, or I am actually tapping into the underlying asset class market, i.e. trading the prefs, trading the bonds, trading the stocks, trading the foreign exchange that's overlaying these ETFs, all these different pieces basically that make up this ETF. And I am doing that with the market, and I'm also using these underlying assets in a creation redemption mechanism to basically create more shares of this ETF, and that actually brings more liquidity to the market. So there's an inherent optionality as well in these creation redemption mechanisms, which basically I use to my benefit to extract liquidity and then give that liquidity back to the end consumer, the person trading the ETFs.
Thanks, Jimmy. So that creation redemption process, I think maybe is the most difficult for some investors to understand. But really, what this is an ETF is an open-ended fund, which means we can make more of it, or we can take some off the market and disassemble it and sell it off to parts as well. And this is a very important layer of liquidity when understanding ETFs. So thanks for walking us through that. So here's a great slide, and Jimmy, you shared this with me, just kind of how the ETF ecosystem works and how market makers fit into that ecosystem. Can you walk us through this slide here?
Absolutely. So this slide basically shows you how all the different participants in the ETF market come together to actually, provide that ETF that you're looking to purchase. So on top there, you have your index providers and your sub-advisors. So those, for example, would be BMO Asset Management, where they have, a whole suite of ETFs that they're offering, right? In the middle there, there's the market maker. So it's people like myself who are continuously making markets on these ETFs, right? So between me and the ETF provider, let's say BMO GAM in this case, there is this mechanism called the creation redemption mechanism that we just mentioned. Now, whenever I'm trading these ETFs, let's take a fixed income ETF for example. Let's say I sold, a block of these fixed income ETFs to an end consumer. I have to actually go into the OTC market, source a replica of this basket of underlying bonds, which I would then deliver to BMO GAM in this case to create more units of this ETF. Now, to your point, this is exactly why this is considered an open-ended fund, because in the same mechanism or the inverse of this mechanism, I am constantly buying and selling bonds in the OTC market, while at the same time using the creation redemption mechanism to create or redeem more shares of this ETF, depending on the demand that we're seeing for that specific ETF at that point in time. And this all happens pretty much seamlessly in the background. So every time you're buying or selling a fixed income ETF, for example, there's a whole massive web of transactions that's going on in the background. And as a market maker, I would be the person sitting in the middle, liaisoning all these different pieces and putting together that ETF while partnering with the ETF issuer.
Thanks, Jimmy. It sounds like a busy day for you to be doing this constantly all the time. So maybe you can tell us a little bit about, your experience. What is an ETF market maker? Why are they so important to ETF liquidity? And what does your day look like when you're buying and selling, trading ETFs and then the underlying basket of stocks and bonds?
Yes, so my job is almost like a translator. So I have to keep an eye on global market events, on certain specific single name events, like say a company just came up with a new headline or an acquisition. I have to look at foreign exchange markets. I have to basically draw all these bits and pieces of information to come up with an assessment on the value of the underlying assets. And then in real time, I have to translate that into what does that mean for the ETF? Because what is an ETF other than a basket of bonds or a basket of the underlying securities, a basket of stocks or a basket of prefs? So basically, in summary, I would have to be able to absorb all this information, translate that into a price on the ETF, while at the same time trading all these underlying assets and at the same time managing the creation redemption mechanism and the buy and sell flows that we're seeing from the ETF market participants.
Sounds like a busy day. And I know it's been a busy week because BMO ETFs listed 10 new ETFs yesterday. And we really rely on our market makers like Jimmy and his team to get these ETFs up and running and get them ready to be listed. So Jimmy, what would it look like a week like this when you are helping us out on the asset management side, get ETFs ready to go for market and get them ready to be listed?
Yes, so that's a very good question. It is similar to how an IPO would work on a single name stock. Whenever you see an IPO of a new company on CNBC and everyone's zooming in on the one guy who's about to open the stock, it is pretty much the same concept. So we are taking a fresh new basket of bonds, converting that into the first ETF, the first share of that ETF for the day, publishing prices on that ETF, and basically managing the open to make sure there's no slippage. Now, because of how efficient the ETF mechanism is, almost instantly the price of the ETF will be reflected pretty much exactly at NAV. So you will never get these crazy massive swings that you see, such as in a stock IPO. But pretty much almost instantly, the price of the ETF will revert to exactly the equivalent price of the underlying assets. So the first day or couple days is exactly that, just making sure that the liquidity is there. Obviously, and this actually goes back to a previous point that we talked about, which is the liquidity of that ETF, even though it has small AUM or small trading volume on day one, the liquidity on day one is exactly the same as the liquidity on day 30, day 60, day 90, it doesn't matter. Because at the end of the day, liquidity is a function of the underlying assets plus a bit of the natural liquidity. But since we are stepping in on day one and we have access to all the underlying assets, you will notice that even on new launches, such as the new BMO launches, liquidity will be there from time zero all the way across.
Yeah, that's a great thing to highlight. I know investors who are looking at an ETF that might be more young or just launched, and they're thinking about, they might be looking at a volume metric and seeing the volume is low because it was just listed. They can be reassured knowing that there's a whole team of market makers behind the scenes who actually subscribe. Using your IPO example, you guys come in 2 days usually before it's listed to the public market. to get basically get an initial offering, or you guys start with those shares to have them ready to go when it's listed. So a lot happening behind the scenes for sure to get an ETF to market, and of course market makers, such an important part of that process. Now here's another question we get often from investors, is a concern that a large trade in an ETF, or a large ETF for that matter, will have an impact on the underlying holdings. And you had that wonderful example at the beginning about selling out, I think you said $1.4 billion out of an S&P 500 ETF. So would something like that, Jimmy, affect the underlying shares, a big trade like that, or not?
That's a very good question, and it's definitely a topic of conversation we have with clients all the time. So the best way to think about it is, what are you trading? So whenever you're trading a big block of something, you have to actually stop and think, okay, what exactly am I trading here? If I'm trading something like S&P 500, then obviously the liquidity is massive. But let's take another extreme example. Say you're trading, small cap oil and gas exploration companies based in Europe after the European market has already closed for the day, and you're trying to execute a big block of something, then yes, then you're paying, liquidity will be very expensive, and that will definitely, your trade will definitely impact the market. So in summary, you have to actually know what are you trading and what are the different components that you're exposed to. So are you exposed to foreign exchange? Are you exposed to foreign markets before or after they're closed? What time of day are you trading? Is there an economic data release that's about to, that just happened that has a big impact on the market? Say FOMC decision or anything like that. So basically, you have to actually understand, what are you trading? What time of day are you trading? The size of the trade compared to the market you're trading in. And you have to make an assessment based on that. And in summary as well, like, we're always available for any of these questions. That's our job. Our job is to be here and help you manage through all the trading that you have. Ask us any questions, and we're happy to guide you through all of them.
Thanks, Jimmy. And then what we're looking at here, just to illustrate your point a little further, here is a very large trade we saw go through on the BMO Aggregate Bond ETF ZAG. It happened at about the day I pulled this, it happened at about 11:20. It was a significant amount of shares, but as you can see, the trade went through and the price of the ETF remained stable. The bid and ask remained stable. So having little to no impact on the ETF is something that's great to highlight. Here's another kind of way of looking at it. So Jimmy, with the trading activity of an ETF versus the underlying stocks or the underlying bonds, what can you share about that?
So actually, I have a very fantastic example for this slide that I would like to share. So, let's take an extreme example. March 2020, height of the pandemic, markets are crashing. Pretty much the bond market, the OTC bond market, ceased to trade. There was virtually no liquidity in the bond market. The ETF market was still trading. Sure, there was a bit of a discount to NAV, there was a bit of a premium to liquidity, but all that was perceived discounts to NAV because the bonds were actually not trading at all. So the fact that ETFs were still trading while the underlying stopped trading is a massive testament to the liquidity of ETFs. I remember back then we did a block of ZAG I believe it was about $200 million worth of ZAG at the height of the pandemic when the bond market stopped trading. And we were able to execute it at fairly competitive levels, given the market condition at the time.
Yeah, that's such a terrific example. I know here I'm showing bank shares, which are fairly large and liquid, but back in March 2020 was a huge test for ETFs, and it proved a lot of ETF naysayers wrong when we saw what the ETFs did for the underlying bond markets when, like you mentioned, bond markets ceased to trade, and yet the bond ETFs continued to trade, which meant they continued to provide liquidity for investors. They were able to buy and sell even through that really difficult time. And of course, you would see a bid-ask spread get wider. That would reflect the heightened risk in the market, the heightened risk the market makers are taking on. However, it's still being traded. And I think that is such an excellent example. So here's as we kind of wrap up here, I'd love to give just a few trading notes and a nice reminder to everyone out there who is trading on their own. Here's a little bit or a couple thoughts or considerations as you're making trades. So the first is the market open and the market close, which is around the first 30 minutes and the last 30 minutes of a day, can often be the most volatile times of the day. And so consider maybe trading around these times so you can avoid that market volatility. And then I might even add on to this, and Jimmy, you mentioned it. Also, look at are there big economic reports coming out in the day? Are there big announcements? Is the Fed going to announce on interest rates? Is the Bank of Canada going to announce on interest rates, or are inflation numbers coming out? These type of data points, when they're released, also create a bit of market noise until they're digested. So just have those considerations when you are trading. We also like to provide the consideration, use limit orders over market orders. And why we say this is because a limit order allows you to avoid any surprises in the market. You kind of know exactly the price you will be getting in and getting out of. And then lastly, trading when the underlying market is open. And sometimes this is more difficult. For example, if you'd like to purchase a Chinese equity ETF and you're on Eastern time, I don't know how many hours in the day that you would be able to trade in Eastern time while the Chinese equity market is open. But again, something to think about, and you probably would expect a bid-ask spread to be slightly wider on an ETF like that, which might be accessing a market that isn't open during the hours that you're trading. So just a few things to consider. We have a little bit of time left for questions, so I will take them now. The first one is about inflation, and this is the topic we covered last week. This investor would like to know why the hesitancy to raise rates, and is there an ETF strategy to protect or hedge against inflation? So we did not see interest rates they haven't been raised yet. There is some speculation that they will, probably by the spring or by March. And I think what we're seeing here is just some prudence from the Bank of Canada, because we have seen some market volatility in the new year. And the Bank of Canada and the Fed, for that reason, probably wants to see some solid footing in markets before they decide to start raising rates. But we do see that, or there is speculation that is on the horizon. For an ETF strategy to hedge against inflation, we talked a lot about this on our webinar last week, so I encourage you to check out our YouTube channel and watch the replay. But we did talk about things like real return bonds and US TIPS as something in the fixed income side. And then in the sector side, we talked about sectors like banks and REITs and infrastructure. But please check out the webinar from last week if you'd like to dive into that topic further. And then our last question, in a portfolio which is weighted Canadian bank stock and other stock providing monthly dividends, what's the advantage in using an ETF instead? I think about what we talked about today, using an ETF, just providing that liquidity, that efficiency to get in and out of a basket of stocks, all in a single trade, versus having to go out and buy several different stocks on the Canadian bank side and several different dividend stocks. You can access everything in a single ETF. So that's a benefit of that as well. Also on the rebalancing side, an ETF, for example, a bank stock ETF, you can look at an equal weight like BMO's, which is ZEB, or market cap weighted, but they are rebalanced and you don't have to worry about doing that. And of course, avoiding the trading costs as well, having to just purchase one ETF versus all the stocks. So there's just a few benefits there. Thanks so much for joining us. We hope to see you next week We have Mark Rays back on. He is going to talk us through our 2022 ETF Outlook report. You don't want to miss that. We'll see you next Friday at 1 o'clock live, or we'll see you on our YouTube channel. Thanks for tuning in.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.